Okay, now we're going to talk about financial statements and their contents a little bit. I thought I'd introduce you to my cat who wants attention, so she's sitting right in the middle of the presentation. she's real funny. Okay, Kitty, we gotta move this. Okay, so we're looking at an income statement here first, and these are this is a manufacturer versus a service provider, and the only real difference might be, this might be called cost of services. Okay, but there aren't really that many differences between the two. But what I'm interested in here is the basic structure, that we've got revenue less cost of goods sold gives us gross margin. And as soon as you see gross margin, then you know that this is an absorption-based income statement, okay, as opposed to a contribution-based statement. Then we've got selling, general, and administrative expense gives us operating income, and this is probably the most important. She's something else, huh? This is the most important number right here. And what's key about operations is this is what you're in business to do, is operations. So this is this is what you can expect income to be next year. Okay, this is a repeatable core business number. Okay, without changes in the underlying companies or anything like that. Anything else that's weird, here we've just got tax expenses, but you could also have gains and losses and a bunch of odd things, okay, they're generally one-time hits. All right, but this structure is really important, and that's what you would want to use for an income statement. Okay? All right, then let's take a look at, the other thing that's important is it's for the year ended. So this is an as-at date, okay? It's a snapshot at the, no. It is not as-at. It's a collection. She's driving me crazy. Come on, Katie. It's a collection of dollars over a period of time. So whether it's a quarter or 6 months or a year, the income statement speaks to the entire period. Okay. Now the balance sheet. There's a balance sheet on the next page here. This is just page 9, and you know there are a lot of accounts on here, and I'm sure you're familiar with them. But what I don't generally see is a real nice organization when I look at your statements and that. So you want to have, first of all, assets here and liabilities there. And then we want both broken down between current and long term. Okay, and labeled that way. All right, everything that you do is for the financial statement reader, and they are not accountants. All right, this is for somebody who's probably maybe sophisticated in reading a financial statement. It's not just somebody that you pulled off the street. But at the same time, it's got to be in a nicely organized fashion. And this says as of December 31st. So this is a snapshot, right? A snapshot at a point in time. The other thing that's important here are intangible assets. This used to be, years ago, I mean, this is just one line on a statement. Now it's a great big area. And I remember, I think Exxon bought maybe Mobil, okay, some other big oil company, and the price was $11 billion, and $10 billion of it was goodwill. Can you imagine? So $10 billion of 11 was just expected earning power. That's what it was. So this is a big area. Yeah, very difficult to audit, difficult to attest to, and to come up with estimates for. Okay, estimating goodwill is difficult, no question. And then down here for stockholders' equity, here we've got common stock, retained earnings, and then some treasury stock, okay, and some comprehensive income, which kills me. But common stock is contributed capital. Okay, this is what was put into the business, and retained earnings is earned capital. This is what's been earned by the company over a period of time. Okay, so I like this distinction here. I think it's useful. Okay, turning the page. You can read about these categories if you want, if you're confused about it or anything. In case I'm in the bottom of page 11 now, and this has the one kind of important thing to remember is the formula for a line, and this is actually our cost function. Okay, and as they say here, it's for a linear equation, but this y is your total cost equals the variable cost per unit times the number of units plus the fixed cost. Okay, You remember, you probably remember this, but I'll tell you what I usually do is I will write total cost equals variable cost times the quantity plus fixed cost. Okay, and to me that's easier for me to see, you know, and remember and all that other kind of stuff. Turn the page again. There's a little bit on here on cost, volume, profit, and breaking even. We don't have to work on this right now. This is on page 12. So the concept of cost, volume, profit, it's in chapter 4. It's a very big chapter, so it's worth it's worth it to you can wait until then, I think. But I don't know if you remember this, but if we take our fixed cost and divide it by the contribution margin per unit, okay, that'll give us break-even units. Okay, and break-even is when operating income equals 0. Okay, that's what we want. Alrighty, so, but we'll talk about that then. Don't worry about that so much. This is an important area though, right here, and I don't know if you did this in 20. You must have done it in 2071. I think you did. And this is the difference between like a absorption-based income statement and a variable cost-based statement. That's pretty good. Huh? Okay. So here, when we look at this first statement, you can see that this is that this includes a gross margin. Okay, and if it has a gross margin, that means it's absorption. In other words, the inventory absorbs a piece of fixed cost. Okay, if it says contribution margin, then we know it's a variable cost statement. I hope I spelled it right. Now the next thing to look at though are the accounts that are used. So for cost of goods sold, under an absorption-based statement, I've got variable cost of goods sold and fixed cost of goods sold. Okay, and this is absorption. So this is actual cost of goods sold, and then down here we've got variable SG&A and fixed SG&A. This is not the way they're really reported, but it's just one way to shuffle around these categories so you can see what happened. And these are organized by cost by function. Okay, these costs relate to product cost. Okay, everything here is about the product. And all these numbers are about period costs. Okay, and I'm on page 13 of the refresher. Okay, and over here on the variable cost statement, these are organized by cost behavior. Okay, so I'm going to say organized by cost behavior, because we can do a lot with these numbers. We can predict all kinds of things. These are variable. All right, and down here we'll have our fixed cost. All right, and the one thing that the difference between the two is the fixed overhead. Okay, and it would be in fixed cost of goods sold right in there. On a contribution based statement, this is deducted in full. All right, over here on this side in the absorption base, it's only deducted in as far as it attaches to a unit of product. Okay, I think that's all I wanted to do right in here. Now, there's a piece and a bunch of stuff in here on before and after tax profits. Okay, don't worry about this. We'll do this ourselves. Okay, we'll do this later. It's not really review type material. Okay, so what else do we have here? Quantitative and qualitative considerations. Oh, let's do one more piece here, and then we can do some problems, okay? I think we're almost there. Nope, there's still more stuff here. No, this is a repetition. Yep, then we can do some problems. So if we look at, I'm on page 16, and this talks about business decisions here. Okay, and this is one of the major things that we do in managerial accounting, is provide support to figure out, should we insource, should we continue to make a product, or do we outsource it? Do we have somebody else doing it? Okay, like, would you believe it or not, now human resources is outsourced. Okay, and I actually think that USF, from some things I've heard, I think we outsourced our IT, which drives me crazy. So if we have problems, we'll never get help. I mean, that's all that means. And then down here, keep versus dropping products. What if we've got a product line that looks like it's losing money? Okay, how do we evaluate those numbers? So do we keep the product or do we drop it? Okay, what happens to total income? Here's another one here. Oh, to keep versus closing locations. Okay, do we just get rid of a location because it looks like they're losing money? There are a lot of different things to think about there. Okay, next we'll do some problems.